Welcome to Institute of Banking Excellence. Today we are going to talk about RBI reaction on COVID-19 and 7th bi-monthly monetary policy. Before starting the video, if you like our videos, please press the like button, subscribe to our channel and share it with your friends. Don't forget to press the bell icon so that you can get daily notifications whenever we post a new video. Without wasting much time, let's get started. 7th bi-monthly monetary policy statement 2019-2020. The Reserve Bank of India issues 6 bi-monthly monetary policies during a financial year. However, owing to the critical financial situation in the wake of COVID-19 effects on financial markets and economy of India large, the RBI has issued 7th bi-monthly monetary policy statement on the 27th of March 2020. The decision taken by the MPC during its meeting held on the 27th of March 2020 decided to 1. Reduce the policy repo rate under the Liquidity Adjustment Facility (LAF) by 75 basis points to 4.40% from 5.15% with immediate effect. 2. Accordingly, the Marginal Standing Facility (MSF) rate in the bank rate stand reduced to 4.65% from 5.40%. 3. The reverse repo rate under the LAF has been reduced by 90 basis points to 4.0%. 4. The MPC also decided to continue with the accommodative stance as long as it is necessary to revive growth and mitigate the impact of coronavirus, COVID-19, on the economy, while ensuring that inflation remains within the target. These decisions are in consonance with the objective of achieving the medium-term target for Consumer Price Index, CPI inflation of 4% within a band of ±2%, while supporting growth. The factors is assessed by RBI to make the above decisions are as under. Global factors. 1. Global economic activity has come to a standstill as COVID-19 related lockdowns and social distancing are imposed across a widening swathe of affected countries. 2. The outlook is now heavily contingent upon the intensity, spread and duration of the pandemic. There is a rising probability that large parts of the global economy will slip into recession. 3. Financial markets becoming highly volatile from January 2020 onwards due to the outbreak of COVID-19. 4. Panic sell-offs across advanced and emerging economies alike. The sell-off has led money flying to safe havens, resulting in adverse effect on emerging economies in more than one ways like 1. Sell-off lead to rising bond yields. 2. The depreciating rupee against dollar as dollar remains the safe haven. 5. International crude prices initially traded with a softening bias from January in anticipation of demand weakening due to the COVID-19 outbreak. Production cut disagreements among key oil producers, however, set off retaliatory supply scale-ups and a price war that plunged international Brent crude prices to a low of $25 per barrel on March 18, 2020. These developments are likely to dampen inflation across advanced and emerging economies. Central banks and governments are in war mode, responding to the situation with several conventional and unconventional measures targeted at easing financial conditions to avoid a demand collapse and to prevent financial markets from freezing up due to illiquidity. Domestic economy. 1. The real GDP growth of 4.7% was estimated by NSO for Q4, 2019-2020 and the annual growth in view of last quarter was estimated at 5%. The same is now at risk due to pandemic's impact on the economy. 2. Inflation. A. Consumption expenditure has been hit hardest. B. The supply side has been severely affected as well. Dislocations in casual and contract labor would result in losses of activity in many sectors as well. C. Price may remain firm across protein-rich items, edible oils and pulses. D. The demand due to COVID-19 may weaken going forward. 3. Equity markets are facing massive sell-offs by foreign portfolio investors, FPIs. 4. In the bond market, the yields have risen on sustained FPI selling. 5. In the forex market, the Indian rupee, INR, has been under continuous downward pressure. Outlook. 1. The food prices may soften. 2. The collapse in crude prices should work towards easing both fuel and core inflation pressures. 3. As a consequence of COVID-19, aggregate demand may weaken and ease core inflation further. 4. Heightened volatility in financial markets could also have a bearing on inflation. 5. If COVID-19 is prolonged, it can have adverse implications on Indian economy as A. The supply chain disruption may get accentuated. B. Global slowdown could deepen. The MPC felt that macroeconomic risks, both on the demand and supply sides, brought on by the pandemic could be severe. The economy needs to be shielded from pandemic effect. All the members voted for a reduction in the policy repo rate and maintaining the accommodative stance as long as it is necessary to revive growth and mitigate the impact of COVID-19 on the economy, while ensuring that inflation remains within the target. Liquidity management. COVID-19 has resulted in major adverse impact, including the following, on Indian financial markets. A. Sell-off in equity, bond and forex market. B. Redemption pressure have intensified. C. Trading activity has reduced considerably, leading to difficulty in accessing instruments of liquidity. D. Tightened access to working capital facilities. Targeted long-term repo operations. The RBI has brought targeted long-term repo operations (TLTROs) of Rs 1 lakh crores at floating rate linked to policy repo rates. The banks can borrow from RBI under TLROs and utilize the funds for investment in corporate bonds, commercial papers, non-convertible debentures. The banks shall make 50% of investment in primary market. The investment made under this can be kept in held to maturity (HTM) over and above the limit of 25% of total investment permitted to be kept in HTM. The exposure shall further not be included in large exposure framework. Cash reserve ratio, it has been reduced from 4% of NDTL to 3% of NDTL. It will release liquidity of around Rs 1,37 crores in financial system. The minimum daily CRR balance requirement has also been brought down to 80% from current 90%. Marginal standing facility. Banks can borrow overnight by dipping 3% into their statutory liquidity ratio as against previous limit of 2%. The combined liquidity released by all these three measures will be Rs 3.70 lakh crores. Relaxation in NPA norms. Term loans, 3 months moratorium permitted on installment on all terms loan outstanding due on the 1st of March 2020. All repayment schedules to be shifted 3 months hence. Working capital facilities, deferment of 3-month period is being permitted for payment of interest in respect of all cash credit overdraft facilities. The accumulated interest to be paid after expiry of deferment period. Deferments. Deferment in implementation net stable. Funding ratio. Base Committee on Banking Supervision has introduced net stable funding ratio. It's banks' ability to fund their activities with stable sources of funds over a period of 1 year. The NSFR of 100% was to be implemented by the 1st of April 2020, which has now been deferred till the 1st of October 2020. Deferment in capital conservation buffer. The banks are required to maintain capital conservation buffer of 2.50% of their RWA. It was implemented on tranches of 0.625 and last tranche was deferred till the 31st of March 2020, which has now been deferred in view of COVID-19 to the 30th of September 2020. This is it for this video. Thank you so much for your love and support. Stay tuned for the next one. Till then, bye and stay blessed.